Hi, this is Alex Fensky, the lead agent for the Chicago Southland Homes team at Keller Williams Elite here in the south suburbs of Chicago. And I want to bring you the April housing market update. We've got numbers now through the end of March, and today is April 4th, 2023. I'm going to cover some important metrics, some things that we measure that tell us what's going on in the market, and a little bit about where we think things might be headed. Although it's obviously always impossible to predict exactly what the future looks like, we have some clues. And most importantly, how to interpret this information or what it might mean for you. We'll start by talking about housing affordability. We'll go into some different metrics of supply and demand and the balance of the market. We'll touch on prices, mortgage rates. So we'll kind of hit all those different things. For personalized real estate advice, because even this is still overview information, even though it's specific to our broader market area, it's not specific to your specific market area. So please do contact me for individualized advice. Comment below, send us a message, go to our website, chicagosouthlandhomes.com, whatever way you want to choose, but contact me for individualized advice because markets are different at a hyper-local level, and I want to give you the best guidance possible. So with that said, let's dig in. First off, housing affordability. Now, these are some kind of old numbers because these are nationwide numbers. The National Association of Realtors has released data up through January that shows that through January, the housing affordability index, meaning overall affordability of homes, improved into January by a few points. And that's something that takes into account housing prices, mortgage rates, and household income. So as those three factors change, how much money it takes out of a person's monthly income to own a home makes a difference in how much people can spend, how much they're willing to spend, whether they need to sell a home. And so affordability improved a bit. So that was good. Prices were down a little bit. Mortgage rates were down a little bit. And so that made the overall index a little bit better. And it's worth pointing out that the Midwest region remains by far the most affordable region of the four in the country. By far. So with that said, let's touch on some local market stats. And this is for Northeastern Illinois, basically the Chicagoland metro area. I'm going to my tool here, InfoSparks. This is offered through Midwest Real Estate Data, which is our MLS service. So this is pulling all the data from there. And this is for all residential property. So the first thing we're going to look at is a couple different metrics relating to supply. First off, new listings. So you can see here, here is our new listings for our MLS in March. It was down 28.6% compared to last March. And you can see just from looking at this curve, if I zoom out a bit, you can see it's pretty low. It's pretty low. In fact, that was the fewest new listings in any March on this chart. And that was felt in the marketplace. What that led to was that homes for sale, and let me zoom back in a bit here, homes for sale, the number of total homes that are available, hit another all-time record low. Last month in February, we hit a new all-time record low, just shy of 15,000 homes for sale, and now we're under 14,000 homes for sale. So it's not just the lowest March on record, it's the lowest month ever. And watch me zoom out on this chart. Here's where we're at. So when people talk about 2008 and they go, oh my gosh, is there a crash coming? Well, you can't have a crash with 13,500 homes for sale in a metropolitan area with 8 or 9 million people. Look back here, there was 110,000 homes for sale in 2008. It's basically 10% of the homes available. For every home today, there was 9 or 10 available at that point. So that's something to note. And what's also weird about what happened with inventory is that it always goes up from February to March. Even in the last 3 years, 2020, 21, and 22, which were weird years for the real estate market. A lot of things happened that don't normally happen. Even in those years, from February to March, homes for sale was at least flat to a little up. It's the first time it's actually gone down. So that's a strange thing and probably the most notable piece of information that will come out of this conversation, the new record low housing inventory. Let's talk a little bit about demand. So demand is actually down too. We measure demand in a couple of ways. One is the number of pending contracts. You can see here that we finished the month at 10,813 pending contracts, which is down almost 21% compared to March of last year. And closed sales is a similar number. Closed sales was down about 23% compared to March of last year. Both those numbers are down a lot from last year, and they match levels that we saw roughly 10 years ago. The reason that the market still is tight and that inventory is going down instead of up is that while demand dropped, supply dropped even more. So overall, there's fewer transactions happening in the marketplace, but there is no near end in sight to the low supply woes that are creating a challenging condition in the marketplace for a lot of people. One big question that we have is how much demand is sitting on the sidelines pent up because of the fact that there's so little available. And I can tell you there's a lot of buyers looking right now that would write a contract today if they could, if there was something to write a contract on. We've got them shopping right now. And so I can tell you, if you put here, we've got 13,579 homes. I bet if you put 2,000 more homes on the market tomorrow, I bet 1,500 of them or more would go under contract within 7 days. So I think our demand numbers would be higher if there was more inventory to satisfy that demand. And so that demand number being down as much as it is a bit misleading because it's weighed into heavily by the limited supply. So let's move on and talk about the way those two metrics work together. One of the most important metrics that I look at is months of supply. Now, you can bear with me, with the terminology can be a little bit weird. Months of housing supply says if you took the pace of sales right now, and you took all the homes that are available right now, and you said, okay, there's this many homes selling each month. How many months would it take to sell off all the existing homes for sale? That gives you a number of months of supply. How long would the current inventory last? And in this case, we're looking at 1.4 months of supply. It's down. It's been going down since September. And to look at where we're at in context, here's where we are. Supply is only going down. I mean, the lowest it hit was 1.3 months, and that was in January and February of 22, before interest rates went wild and before housing affordability really started taking a blow. And we're all the way back down to 1.4. If you take this and do a 12-month average, which erases the effects of seasonality, you can see we're still hovering right around our all-time record lows of housing supply. This makes it a seller's market, and it has the balance of supply. This metric, months of supply, it hasn't changed really since at least about January of 2022, right here. Even before, if you account for small differences. So that's a really important number, along with days to contract. So if you look at median days to contract, and again, take this on a rolling 12-month average because there's seasonality and we don't want that to influence everything. So you can see it's been 9 days or 8 days, dating all the way back to September of 2021. Median days to contract has not changed. So, and again, for context, look at where we're at. That number used to be 50. In fact, if I go back here, the number used to be 64, and now it's at 9, and it hasn't gone up. It's really important to know. So what does all this do to prices? Well, typically when you have low supply, seller's market, short days to contract, all that stuff usually adds up to increasing prices. Right now, prices are actually down from where they were at this time a year ago, but not by much, by 2%. So prices are down 2% compared to last March. That's the 5th month in a row that prices have been down a little bit compared to the same month a year ago. What, again, though, taking seasonality into account, rolling 12-month average, look at that. We've been flat or really, really close to flat since July or August of 22. So you're looking at 8-9 months. that pricing has just flattened out and remained that way. That's weird because it's a seller's market, because it's short supply, because it's short days to contract. But this is the effect of the one of the primary drivers of this shift being the cost of mortgage money and overall housing affordability. So prices are super flat. Now, let's go into the mortgage rate thing a little bit. And for that, let's see if I can pull up another page here for you. I like to use Mortgage News Daily. There's a few reasons why, and I won't nerd out completely about that. But I do prefer this for my mortgage data. The 30-year fixed rate mortgage right now is running right around 6.4%. And there's some weird stuff going on with this. I mean, first of all, that's down about a half point from where it was last month when I gave this report. And it's right around the 6-month average of where the 30-year fixed rate loan has been. If you go back to late September or so, we've been bouncing around in that range between 6 to 7, a little over 7. So we're kind of right in the middle of that range. What's really weird about this, though, is that you normally should get a discount for a 5/1 ARM. That's an adjustable rate mortgage where you've got the first 5 years are fixed, but then the rate resets and changes every year after that. It's a riskier product for a buyer to take on. The bank likes that. They give you a lower rate. Well, 5/1 ARM's running at 6.6. It's higher than a 30-year fixed rate mortgage. And what else is weird is that your government-backed loans, your FHA and VA insured loans, tracking right around 5.9%. It's basically the same as a 15-year fixed rate conventional loan. That's weird. 15-year fixed should generally be lower than those products, but these markets are complicated and there's a lot of different things that play into it. And I say all this to say what you should do if you're buying a home is you should shop and evaluate all loan types that are available to you, because there's so many different, this is just averages, but for each borrower with your credit profile and everything, the type of property you're buying and where, this is going to look different. So it's really important that you shop all the different loan products and shop until and reevaluate again when you write a contract, because what we're seeing is not something I would expect to see. This is strange. So we're participating in a strange market time, and you just got to roll with it. So last point on mortgages is that when we talk about the federal funds target rate, they've got that now up to 5%. It's the highest it's been in a very long time. It's helping with inflation. Inflation's down from, it was up 7-8%. It's down to 5%. But they want it to be at 2. So at 5, it's still 2.5 times higher than it should be. And the Fed is meeting again in May, on May 2nd. They might leave that rate the same. They might bump it by a quarter point, a little bit less than what they've been doing. But a lot could happen between now and May, so I won't make any predictions on that. What is important to note is that they did successfully head off the banking collapses that happened. You heard about those banks that collapsed. They were banks with sort of strange portfolios. So it was a bit of an isolated incident. They were able to keep that isolated and avoid fear and panic spreading to the rest of the economy, avoid runs on other banks. And so that they kept that problem at bay, and that's a good thing they did. It actually helped mortgage rates because that sent some ripples through the financial markets, and that's one of the main reasons why mortgage rates tumbled a little bit off of their peak, which you saw down here. So with all that said, what do you do? Well, generally speaking, if you're a seller right now, understand that the balance of the power in the marketplace still lies with you. You still are the rare thing. There's still more buyers looking for homes than there are homes available. That hasn't changed, but pricing is flat and it's bouncing back and forth around between a little bit lower, a little bit higher than a year ago. Because of that, it's super important that you price to the active competition, not just to the sold comparables. And this is something that a skilled and experienced agent will help you with. If you're only looking at stuff that closed 2-3 months ago, that was recent, but those buying decisions were made 3, 4, maybe 5 months ago at a different time. So we've got to price to the actives in order to really be the best we can in participating in the current marketplace of today. I suspect that we're going to stop seeing those small negative numbers when we look at sale prices being down year over year. I suspect these numbers are going to start showing positive again, maybe as soon as when we close out the April books, based on what I'm seeing in the marketplace. For buyers, my biggest recommendation for you now is shop all those different financing products and see what the best fit is going to be for you for a mortgage. And also know that while you're competing with fewer buyers based on the pending contracts number, the pending contracts number only measures the number of successful buyers that got a contract. It doesn't measure the number of buyers that tried to get one and couldn't. So while it looks like you're competing with fewer buyers, I'm not so sure that you are. Based on a lot of buyers that we're working with, I'd say you're probably competing with more buyers than you think. And it doesn't seem to be based purely on price. If it was, prices will be going up rapidly again. But if you can compete on price, you'll probably have a pretty good leg up in that negotiation. And it's important to note again that there's fewer listings available than there ever have been ever in this market area. So speed is important. Smart negotiating and terms aside from price are all very important for you to be able to get the home that you want. So that's what we've got for you right now. Again, contact me for individualized advice. This is for an entire regional area, and real estate markets are different down to the micro level. So comment, message us, reach out one way or another, and let us help you with your specific real estate needs. Thank you, and I look forward to talking with you again a month from now in May.